So what exactly is backtesting? Think of it as a crucial dress rehearsal for your trading ideas. It is the process of taking a specific trading strategy, complete with its entry and exit rules, and applying it to historical market data. You are essentially asking, how would this strategy have performed in the past? This simulation meticulously reconstructs trades based on your rules. It then calculates the hypothetical profits or losses. This might sound like a simple concept, but its power and importance in a trader's toolkit cannot be overstated. It is a fundamental step, not just an option, but a necessity for serious traders. The main purpose of backtesting is to determine if a trading strategy possesses a statistical edge. Is your idea genuinely effective, or is its perceived success merely a product of luck or wishful thinking? Backtesting acts as a filter, helping you to discard weak or unprofitable ideas at an early stage. This crucial step can save you from the costly mistake of deploying real money on untested concepts. It provides objective, data-driven evidence about a strategy's potential, moving beyond mere gut feelings or intuition. Quantifying potential performance metrics like profitability and risk is critical for anyone serious about trading. It helps build a solid, evidence-based case for or against a particular strategy. Why is this historical perspective so important in trading? Markets, while seemingly random at times, often exhibit patterns and tendencies that can repeat over extended periods. Human psychology, a significant driver of market movements, shows remarkable consistency through different eras. Therefore, a strategy that has demonstrated robust performance across varied past market conditions, bull markets, bear markets, and sideways consolidations, has a statistically better chance of remaining effective in the future. Of course, this is not an ironclad guarantee of future success, as markets are dynamic and constantly evolve. However, it provides a strong indication of a strategy's viability. It's about playing the probabilities, not seeking certainty. Think of backtesting as being akin to a pilot training in a flight simulator. Before ever taking control of a real aircraft, pilots spend countless hours in simulators. They experience a wide range of scenarios, practice emergency procedures, and hone their skills in a risk-free environment. Backtesting offers precisely this kind of simulated experience for traders. It allows you to fly your trading strategy through years of historical market data without risking a single dollar of actual capital. You can observe how the strategy behaves, witness its potential drawdowns, its winning streaks, and its inevitable losing periods. This virtual experience is invaluable for building both confidence in and a deep understanding of your chosen methodology. The absolute foundation of any credible backtest is high-quality data. You need access to clean, accurate historical price data for the instruments you intend to trade. This point cannot be emphasized enough. The old adage garbage in, garbage out is particularly true in backtesting. If your data is flawed, your results will be meaningless. This data could be end-of-day prices, open, high, low, close, volume, for swing trading or longer-term strategies. For shorter-term systems like day trading, you might require intraday data, such as 1-minute bars or even tick-by-tick data. Always ensure your data source is reliable and that the data has been adjusted for corporate actions like stock splits and dividends. Next, consider the length of your historical data. How much history is truly enough to conduct a meaningful backtest? The answer depends on the strategy, but generally, you need a sufficient span to cover a variety of market cycles and conditions. This includes bull markets, protracted bear markets, and extended periods of choppy, sideways price action. Several years of data is often cited as a minimum for many types of strategies. For some systems, particularly those trading less frequently, a decade or even more might be necessary to gain true confidence. Using too little data can lead to unreliable or overly optimistic results, as the strategy hasn't been tested against diverse market environments. With your data sorted, the next step is to choose or define the strategy you wish to test. It's often advisable to start with strategies that are relatively simple and have clearly defined rules. Complexity can be the enemy in trading. Simple, robust strategies often outperform convoluted ones. Your strategy must have precise rules for every action. When do you enter a trade, buy or sell short? What specific conditions, indicators, or patterns must be met? Equally important are your exit rules. How will you manage risk with stop losses? What are your profit targets, or will you use a trailing stop mechanism? There should be no room for ambiguity or subjective guesswork. Let's consider a simple example. A moving average, MA, crossover strategy. The rules could be: buy when a shorter-term moving average, for example 20 period, crosses above a longer-term moving average, for example 50 period. Conversely, sell or initiate a short position when the 20 period MA crosses below the 50 period MA. To make this a complete strategy for testing, you would also define your risk management rules. For instance, implement a fixed percentage stop loss, say 2% of your trading capital risked per trade. You might also set a profit target, perhaps aiming for a reward that is 3 times your initial risk, a 3-to-1 risk-reward ratio. These are concrete mechanical rules that can be easily programmed into backtesting software or meticulously applied manually to historical charts. This clarity is paramount. Now comes the execution phase, running the actual backtest. This involves systematically applying your predefined strategy rules to the historical dataset, period by period, day by day, or bar by bar. For every instance where your entry criteria are met, you simulate a trade. You record the entry price and then you follow your exit rules to determine the exit price, calculating the resulting profit or loss for that hypothetical trade. This process can be performed manually using historical charts and a detailed spreadsheet, which, while time-consuming, can offer deep insights into the strategy's behavior. More commonly, traders utilize specialized backtesting software, as many modern trading platforms offer robust tools that automate this often laborious process. Once the simulation is complete, you need to analyze the results. Don't just fixate on the total net profit. That figure alone tells only a fraction of the story. It is crucial to examine a range of key performance metrics, KPMs. One of the most important is the maximum drawdown, which represents the largest percentage loss your strategy experienced from a peak equity value to a subsequent trough. Understand your win rate, the percentage of trades that were profitable, and the profit factor, gross profit divided by gross loss. Also, critically assess the average win size versus the average loss size. How many trades were generated over the test period? These metrics collectively paint a much fuller and more realistic picture of the strategy's historical performance. Let's imagine a hypothetical example of backtest results for our moving average crossover strategy applied to the EUR-USD currency pair from January 2010 to December 2024. The backtest might show that the strategy generated 250 trades during this period. The total net profit could be, for instance, 120% over the nearly 15-year span. Perhaps the maximum drawdown experienced was 18%. The win rate might be 45%, meaning slightly less than half the trades were winners. If the average winning trade was $300 and the average losing trade was $150, this would yield a positive risk-reward ratio of 2-to-1. These specific numbers provide tangible insights into how this particular strategy might have behaved historically. The final, and perhaps most critical step, is to conduct an honest and critical analysis of these results. This is where true learning occurs. Don't fall into the common trap of becoming emotionally attached to your strategy or your initial idea. Look at the performance objectively. Were there extended periods where the strategy underperformed or incurred significant losses? Try to understand why the strategy performed as it did during different market phases. Above all, rigorously avoid the dangerous practice of curve fitting. This involves excessively tweaking the strategy's parameters to perfectly match the historical data, which often results in a strategy that looks brilliant in backtests, but fails miserably in live trading because it was over-optimized for the past, not robust for the future. The single most significant benefit of meticulous backtesting is unequivocal. It allows you to thoroughly validate your trading ideas before you risk any of your hard-earned capital in the live markets. This is a paramount principle of sound trading. Backtesting serves as an essential filter, enabling you to discard flawed or underperforming strategies quickly and crucially cheaply, costing only your time and effort, not your trading funds. This disciplined approach is a hallmark of professional traders. In stark contrast, amateurs often dive into trades based on fleeting hope, a persuasive hot tip, or insufficient analysis. Such impulsiveness is frequently a direct recipe for financial disappointment. The first rule should always be to protect your capital. Beyond a simple pass-fail judgment, backtesting is an incredibly powerful tool for strategy refinement and optimization. The process is often iterative. You might start with a core concept, and the initial backtest results could highlight areas for improvement. You can then test variations of your original idea. What happens if you incorporate a different technical indicator for confirmation? How do results change if you adjust the parameters of your stop loss or take profit levels? Or perhaps the strategy performs better on a different financial instrument or time frame. Small, logical tweaks, rigorously tested, can sometimes lead to significant enhancements in performance and robustness. Always remember to validate any optimized strategy on out-of-sample data to ensure its integrity. Furthermore, comprehensive backtesting provides invaluable insights into the inherent characteristics or personality of your trading strategy. Beyond just the bottom-line profit figures, it reveals crucial operational details. How frequently does the strategy typically generate trading signals? What is the average holding time for a trade: hours, days, or weeks? What are the typical depths and durations of drawdowns that you can realistically expect to encounter? Knowing these behavioral traits in advance helps you to set realistic expectations for live trading. This understanding is psychologically vital, as it prepares you to navigate the inevitable ups and downs with greater composure, enabling you to stick to your well-tested plan even during challenging losing streaks. So, is backtesting a magical crystal ball that can perfectly predict future market movements? No, absolutely not. It is essential to maintain a realistic perspective. Past performance, no matter how impressive in a backtest, never provides an ironclad guarantee of future results. Markets are dynamic, constantly evolving systems. Unforeseen global events, shifts in market sentiment, or changes in regulatory landscapes can all impact strategy performance. However, engaging in rigorous, honest backtesting significantly stacks the probabilities in your favor. It transforms trading from what might otherwise be a pure gamble into a more calculated, data-driven business endeavor. For any individual serious about achieving long-term success in the markets, mastering the art and science of backtesting is not merely optional, it is utterly indispensable.